Hello, everyone. Welcome to our class in Fundamentals in Accountancy Business Management 2, or some students would call it Accounting 2. Okay, to all grade 12 students all over the Philippines, how are you? And especially to my students in grade 12 Bonifacio, grade 12 Mabini, and grade 12 Magbanwa. Kumusta kayong lahat? They're always telling me to greet them, but I always tend to forget. Now I started my class with greetings. Okay? So now let's start. We will be dealing with the last exercise for the statement of preparation for the statement of financial position, uh, comprehensive income, and the statement of changes in owner's equity. Okay? So next slide we have. Okay, here is now the set of exercise, but I think they are very small in text, but I will be discussing them one by one. Okay, so number one, made initial investment of the following assets on January 1, 2019, cash 2,500,000, merchandise inventory 400,000. So we debit the assets invested because they are assets, they are on the debit side, the normal balance, and the viewpoint of the company is they receive cash and merchandise inventory. And we have to credit equity because that is the owner's contribution to the company. Next, bought machine on account 300,000 on January 30, 2019. Compute for the depreciation. It has 5 years estimated life with a salvage value of 15,000. Okay, but for the information on the depreciation, we will be using that at the adjusting entry at the end. Okay, so number two, the company received machine. Okay, so you debit machine as the asset received by the company, but in exchange for for an accounts payable because the company bought it on account. So there is an accounts payable of credit, which is the normal balance also, of 300,000. Borrowed on May 31, 2019, 300,000 at the bank for a term of 5 years with 12% interest per annum. So this is a bank loans payable. So the company received cash from the bank loan proceeds, and the interest we will be computing it at the time of payment. Okay, so we just debit the cash received 3 million and the loans payable because the company acquired loans. So loans is a credit normal balance. Next, received cash sales of 5 million pesos. So this is a cash sales. So meaning you receive debit cash as an asset account, and sales is a credit normal balance. Correct. So you credit sales. Number five, sold on account 500,000. So meaning the company did not receive cash. What did he receive instead? Yes, the accounts receivable. Meaning the company sold on account. So instead of receiving cash, he received another form of asset, which is in the form of receivable. And since this is a sales, so we credit sales of 500,000. Next, we have paid rent 20,000. Rent expense, as we know, is a debit account. Okay? Expenses is a debit normal balance. So you debit rent expense, 20,000. And because you paid, so you disburse cash of 20,000. Number seven, withdrew 25,000 for his personal needs. Okay, so the owner needs money. So when he withdrew money, that is a deduction to his equity account. but we debit drawing account instead. Okay? So debit 25,000, and since the company disbursed cash, so there is a deduction of the cash account in the amount of 25,000, and to deduct that means we credit the cash. Next, purchased merchandise 500,000, paid half, and the other half on account. Okay, so as I have been mentioning in the earlier video lessons, when we use the inventory method, the perpetual, and the other one is the periodic, we use purchases, okay? To record the cost of your merchandise, we debit purchases for 500,000. And since he paid half on cash, so you credit cash because that is a deduction to your account of cash. So you credit 250,000 cash, and the other was incurred through a liability. So you credit accounts payable for the other half of 250,000. Next, okay, so here now is the interest computation. Borrowed on May 31, 2019, 3 million at the bank for a term of 5 years with 12% interest per annum. So we have to take note of the date. May 31 to December 31 is 7 months. May, June, July, August, September, October, November, December 31. So 7 months. But we have to compute first for the interest, which is principal, times the rate of 12%, times the term loan of 5 years. So it will give us a 1,800,000 interest for 5 years. But since we are paying on December 31, so the loan payable until December 31 is 360,000 is the interest per year. You divide it by 12. So 30,000 per month. And because it has been since May 31 to December 31, so that is 7 months. So it will incur interest of 210,000. Or you may compute it directly this way: 3 million times the 7 months over the number of months in a year over 12 times the 12%. So we get 210,000. Okay? Next, we have the loans payable. We have to debit it because there is a deduction to your loans. Okay? We said that a loans payable is a credit normal balance. But when we deduct our loans, what do we do again? Right, we debit it. So we debit the loans payable because we will be paying the amount of loan of 3 million plus the interest expense, and the expense is a debit account, so we debit interest expense of 210,000, and we disburse cash in the amount of 3,210,000, which is a credit account. Okay, next we have, okay, now we compute for the depreciation. The depreciation, we use the straight line method. The cost of how much it was that? 300,000 minus the salvage value of 5,000 over the estimated useful life of 5 years. So the depreciation per year is 295,000. And since we are computing for how many months? 6 months, because it was bought on June 30 to December 30. That means 6 months. So 4,917 per month times the 6 months, we have 29,500 for your depreciation. Okay, next we have, so we make the adjusting entries. The depreciation of 29,500, credit accumulated depreciation of 29,500. Next, we have the inventory. It was stated in the problem that there was an ending inventory of 40,000. So we debit 40,000 and income summary of 40,000. At this point, maybe you have mastered the preparation of the reports already, especially these journal entries. And now we go to the ledger. So from the following accounts, I think from the many accounts, I think that the account that made many changes are the cash. So the balance is 6,995. How did we arrive again at 6,995? The numbers on the left correspond to your transaction number, and the numbers on the right correspond to your transaction value. Okay? So transaction number one has 2,500,000. I think this is the investment. Okay, so on and so forth. We get the debit balance, deduct it from the credit balance. Since debit is higher than the credit, so we maintain a debit balance of 6,995. Next, we call it, by the way, these T accounts. Okay, then we have also the T account for the accounts payable with a credit balance of 550, and the sales T account or the ledger of 5,500,000. From the T account, then we will now have the ledger balances of accounts. Then we prepare now the trial balance to check the correctness of your debits and the credits. And what do we place on the debits column? All the accounts with normal debit balance, and all the accounts with credit normal balance will be placed in the credit column. So it must always be balanced so that the debit balance is 8,979,500 and a credit balance of 8,979,500. Next, after the trial balance, we now can prepare the comprehensive income. We first prepare the income statement prior to your balance sheet because we need to determine the net income. Okay, so where do we get these values? We will get these values from your trial balance. Okay, so the sales, we just put them to the sales and the other accounts. By the way, what do we call these accounts again? The permanent or temporary accounts? Right, temporary accounts because we need to close this to your equity account later on. So, so sales by this time, by this period, I want you to memorize already the format. Okay, sales less the cost of goods sold, and what is the composition of your cost of goods sold? Beginning inventory plus the purchases is equals to your COGAS or cost of goods available for sale less the ending inventory, then it becomes your cost of goods sold. So your cost of goods sold is deducted from, right, from your sales. Then the sales less the cost of goods sold, you will gain your gross profit, and from the gross profit, you deduct your expenses. It may be operating or marketing expense. So now we get a net income of 4,380,000. Next, we have now the after preparing the comprehensive income, we are now ready to put the accounts, the permanent accounts to your balance sheet or the statement of financial position. Again, what do we call these accounts? Yes, they are called the permanent accounts, okay, or the real accounts. So it is composed of the assets, okay, the following assets. In the merchandise inventory, what figure you use? Yes, the amount in the adjusting entry of merchandise, which is 40,000. Okay, but here is a machine account. You have to deduct the accumulated depreciation to get the book value of your machine. So your total assets must be 7,805,000. It must be equal to your what? Yes, let's check on the next slide. To your total liabilities and equity. So now we will get the accounts payable and owner's equity. Again, in the preparation of your owner's equity, we begin with your owner's equity beginning. So this is the beginning balance at the time of the initial investment, or maybe if it has been operating for several years, you will get your equity balance which is the ending balance of your previous year. It becomes your beginning balance of the following year. Okay? Next, we deduct your withdrawals or the drawing account of the owner. And here is the net income. We forward here the income account of 4,380,000. So we always prepare the income statement ahead of the balance sheet. So now we have the equity again, 7,255,000 plus the accounts payable. So we get a of total liabilities and equity of 7,805,500, which is equal to your, of course, to your assets. Okay? See to it that your assets is equals to your liabilities plus equity. So now if you got the answers right, congratulations. I'm really very proud of you, my dear students, because you are now ready to prepare your financial statements. And this is one of the most difficult part, the preparation, because these are your outputs as accountants. You will be preparing the balance sheet, the income statement, the statement of changes in owner's equity, and number four, wow. Next week, we will be discussing the cash flow. Okay? Statement of cash flow. That's very interesting and exciting topic. So look forward for that. Again, I am at your service, Teacher Jonna. Thank you very much for watching and God bless everyone.